What if I told you that the smartest thing you could possibly do for your wealth is absolutely nothing? Statistically, if you invested in the Nifty 50 over the last 20 years but missed just the 10 best performing days because you were waiting for a dip, your final corpus would be cut by nearly 50%. I'm Zoya, and let me help you navigate the messy intersection of your money and your mind. Most of us are conditioned to believe that active means better. We spend our nights tracking US Fed rates and waiting for that perfect 10% market correction to finally deploy our war chest. We think we're being strategic, we think we're being sharks. But while we're waiting for the perfect entry, the market is usually moving on without us. The real battle isn't against the charts, it's against your own biological wiring that screams wait when the math is screaming go. Let's talk about why your brain is designed to make you lose and how to master the art of disciplined inaction. It's a Tuesday night. You are absolutely soul-crushingly exhausted from the day. You're basically fused to your couch, doom scrolling through social media like it's an Olympic sport, just trying to turn your brain off. And then, right between a vlog of someone eating a croissant in Paris and a cat meme, the algorithm strikes. It serves you a video from that guy. You know exactly the type of finance influencer I'm talking about. Sitting in a ridiculously aesthetic cafe that charges $500 for a coffee, casually sipping his espresso, flashing a screen full of bright green numbers and tossing around jargon like zero DTE options like it's casual dinner conversation. Oh, and bragging about how he just bought the dip and absolutely crushed the market this week. It looks so effortless, doesn't it? And right there, boom! Even though you know better, a very specific psychological trigger gets pulled in your tired brain. The little voice starts whispering, am I completely messing up my life? Am I missing out on massive wealth by just quietly doing the basics? Welcome to the defining financial anxiety of our generation, that deep, creeping feeling of inadequacy. Let me tell you a secret, it's not accidental. It is a direct byproduct of how these social media algorithms intersect with our evolutionary hardwiring. Yes, I said biology. We are biologically programmed as a species to care about relative status. Who has the bigger cave? Who has the better berries? So, when you see this guy supposedly generating massive rapid wealth through hyperactive trading, your brain instantly interprets your own slow, steady SIP saving as an absolute failure. You are essentially dragging a Paleolithic caveman brain into a hyper-financialized digital arena. It's a bloodbath. It makes you feel like you're playing checkers in the mud while everyone else is playing 4D chess in the cloud. But here's the thing, and this is why we are doing this deep dive today. Grab your chai because we're getting into it. The reality of wealth creation in India right now tells a completely different story than the anxiety-inducing flexes on your feed. We are breaking down the absolute fundamental debate for the modern Gen Z and millennial Indian investor. Do you actively hunt for discounts, hoard your cash, and try to perfectly time the market to buy the dip like our espresso bro? Or do you just set up a boring, automated, systematic investment plan, a trusty SIP, and go outside and literally touch grass? The macroeconomic data points to a silent revolution happening right under our noses here in India. If you look at the landscape of the Indian market right now, in early 2026, the sheer volume of capital moving through automated channels is staggering. Let me hit you with the numbers because they are wild. We are looking at over 9.4 crore active SIP accounts. And the monthly inflows? They've crossed 32,087 crore rupees. Yes, you heard me, 32,000 crore. Every single month. To put that in context, this domestic liquidity is fundamentally changing the structure of the Indian market. It's basically creating a massive buffer against the sell-offs we traditionally saw from foreign institutional investors. So that's over 32,000 crore rupees going into the market on literal autopilot, driven largely by retail investors, normal people like you and me. It's not a cute little trend anymore, it's the new baseline. It is literally infrastructure. But hey, big numbers can feel abstract. To really understand the mechanics and why the math heavily favors one specific psychology, we need to bring this down to the individual level. Let's take Rohan and Manoj. They are both in the exact same financial position, making the same salary, probably eating the same overpriced biryani on weekends. They both have the exact same goal: invest 15,000 rupees every single month into a standard Nifty 50 index fund for 5 years. So the variables are locked. Same amount, same destination, same top 50 companies in India. The only difference? Their philosophies. We are literally testing human behavior against pure, cold, systemic automation. Let's look at Rohan's blueprint first. Rohan is taking the zero-stress, highly automated route. He's the set it and forget it guy. He opens his shiny fintech app, Zerodha, Grow, whatever, and sets up an electronic mandate, an e-mandate. On the 7th of every month, 15,000 rupees is snatched from his salary account before he can even think about spending it on a Zara jacket. Boom! Deployed directly into the Nifty 50. But Rohan does something else, something truly wild. Once that mandate is active, Rohan completely uninstalls the trading app from his phone. I know, right? Who does that? He just deletes it. He removes the UI, the notifications, the absolute temptation to meddle. He is essentially adopting the legendary John Bogle philosophy. Don't look for the needle in the haystack, just buy the entire haystack. And we need to unpack why buying that haystack is such a boss move. John Bogle didn't just invent index investing so we could be lazy. Though, let's be real, the laziness is a massive perk. But he understood the self-cleansing mechanism of an index like the Nifty 50. Think about it. The Nifty 50 isn't just a static list of companies that sit there forever. It's a VIP club. If a company starts slacking, its market cap shrinks, the bouncers kick it out of the index, and it gets replaced by a faster growing competitor. By just holding the index, Rohan is guaranteed to own the absolute winners of the Indian economy without ever having to read a single boring balance sheet. It's a huge relief. But let's talk about deleting the app. That is a masterclass in modern behavioral defense. Because Rohan is dodging what Silicon Valley UX designers literally engineer into these platforms. The dopamine loop. Oh yes, modern retail trading platforms are built on the exact same psychological principles as casino slot machines. Variable reward schedules, B.F. Skinner's operant conditioning. The pretty colors, the little pink sounds. When you open your app and see bright green text, little confetti animations, or push notifications screaming that a stock is moving, your brain gets a massive hit of dopamine. It rewards the act of simply checking the screen. By automating his SIP and yeeting the app into the digital trash, Rohan is insulating himself from his own neurobiology. He is literally protecting himself from himself. He knows he doesn't want to be a full-time financial analyst. He wants the compounding magic without the massive cognitive load making him age prematurely. But hold on, I can hear the finance bros typing their comments already. Let me play devil's advocate. Zoya, isn't blind automation dangerous? What if the Indian market shifts? What if we enter a multi-year bear market? Is Rohan just sticking his head in the sand like an ostrich by refusing to look at his portfolio? I hear that counter argument a lot, but it completely, fundamentally misunderstands the nature of equity risk. If you are investing for a 15, 20, or 30-year horizon, macro-level market volatility in the short term is completely, utterly irrelevant to your terminal wealth. Monitoring your portfolio daily during a 20-year investment horizon is like opening the lid every 2 minutes when you are slow cooking a rich, authentic dum biryani. You aren't helping it cook faster, bro. You're just letting all the precious heat out and ruining the dish. The risk of the entire Indian economy fundamentally collapsing? That's a systemic risk. If that happens, we have bigger problems than our portfolios, okay? What Rohan eliminates is the behavioral risk. The risk that he will panic, sweat profusely, and sell at the exact wrong moment. You can't control the macroeconomy, so you build a fortress around your own micro habits. Which brings us to our second guy. Let's talk about Manoj. Manoj is, well, he's the complete opposite of Rohan. He's the guy in your WhatsApp group chat constantly sending screenshots of charts with crazy trend lines drawn all over them. Manoj looks at Rohan's SIP strategy and thinks, wow, how fundamentally naive. Why would you blindly buy on the 7th regardless of valuations? Manoj operates under the massive assumption that he, a regular dude with a laptop, can identify when the market is overvalued with pinpoint precision. So here is Manoj's master plan. He takes his 15,000 rupees every month, but instead of investing it, he parks it in a basic liquid savings account. He tells everyone he is building a war chest. He's waiting for his moment. Very dramatic. He monitors the market constantly, eyes glued to the screen, waiting for a specific trigger. His golden rule? He will only deploy his cash when the market takes exactly a 10% dip from its recent peak. He wants to buy wholesale, not retail. He thinks he is a highly rational, analytical market sniper. Spoiler alert, this is a textbook example of a massive cognitive illusion. Manoj truly believes he is using deep analytical reasoning. But if we look at Daniel Kahneman's Nobel-winning research in thinking fast and slow, Manoj is entirely hopelessly captured by System 1 thinking. Let's break that down because finance pros misuse these terms constantly. System 1 isn't just being emotional. Kahneman outlines 2 modes of thought. System 1 is our fast, intuitive, pattern-recognizing engine. It's automatic. It's what lets you drive home on autopilot or instantly recognize when your mom is mad at you just by how she says your name. System 2, on the other hand, is the slow, deliberate, energy-draining process of logic, like solving a complex calculus equation. Manoj thinks because he's looking at candlestick charts and reading financial news, he's using System 2. But market timing is largely driven by overconfidence bias. His System 1 brain is finding fake patterns in random market noise. His ego has essentially hijacked his logic. He sees the market moving and convinces himself he has an edge over institutional supercomputers. And this overconfidence is an epidemic right now. Since the massive retail influx around March 2020, we've seen millions of new investors enter the market. SEBI, our market regulator, literally releases reports highlighting the absolute devastation this active trading mentality causes. Over 90% of retail traders lose money in the derivatives market, particularly futures and options. 90%. Now, Manoj isn't gambling on high-risk market bets, but his psychological hubris is exactly the same. He truly believes he can outsmart a complex adaptive system. Let's look at the actual math of his logic. Because the concept of waiting for a 10% dip has a massive mathematical flaw right out of the gate. A 10% dip from where, Manoj? The baseline matters. Let's say the market goes on an absolute tear, going up 25% over a year, and then finally dips 10%. Manoj is absolutely thrilled, thinking he's a genius buying the dip. But a 10% dip from a 125 baseline brings you to 112.5. He is still buying at a significantly higher absolute price than if he had just invested on day one at a baseline of 100. It is a fundamental misunderstanding of how a rising baseline works. That is the core fallacy of market timing in an expanding economy. Manoj is anchoring to the peak, viewing a drop from 125 to 112.5 as a massive discount. He completely ignores the opportunity cost of the initial 25% run-up that he totally missed because his capital was sitting lazy in a savings account. Let's see exactly how that plays out in our 5-year showdown. Now, we advance the timeline to the first 8 months of Rohan and Manoj's journey. The macroeconomic environment is strong, corporate earnings are great, and the Nifty 50 goes on a classic bull run, appreciating by 12% over those 8 months. For Rohan, this is entirely invisible. The algorithm just pulls his 15,000 rupees every month, and because the price is rising, his money buys slightly fewer units each consecutive month. But the base of units he bought in months 1, 2, and 3 are now sitting on fantastic gains. He is experiencing the uninterrupted, beautiful compounding of his capital. His money is fully deployed, capturing dividends and capital appreciation simultaneously. But Manoj? Oh, Manoj is sweating. He has been disciplined, dutifully saving his 15,000 every month like a good boy. He's sitting on over 1.2 lakh rupees in cash in a basic savings account, earning a nominal interest rate that barely matches inflation. He's been waiting for his 10% dip, but the market just keeps climbing. And the psychological pressure here is immense because opportunity cost isn't just a financial term. It has a very real emotional weight. Manoj is watching his peers make money while he is stuck in cash. Then, finally, the market stumbles and we get a minor correction, with the index dropping by 4% over a few weeks. Manoj gets the notification on his phone, and this should be his moment to deploy some cash, right? He's finally getting a discount, but he freezes. Why does he freeze? Because cognitive biases rarely act alone. What Manoj experiences here is a paralyzing mix of anchoring bias and loss aversion. He established a strict arbitrary rule: wait for a 10% drop. When the market drops 4%, his System 1 brain kicks into overdrive and assumes momentum. It tells him, bro, if it dropped 4% this fast, it's easily going to hit 10%. If you buy now at 4% and it drops another 6%, you are going to look incredibly foolish. He literally invented the number 10 out of thin air, and now he is a hostage to it. And I'd argue there's another layer here. It's the fear of regret. If he buys at a 4% dip and it drops further, he has to face the reality that he made a bad trade. If he stays in cash, he hasn't technically made a trade, so he can maintain the illusion that he is still in control. It is the psychology of omission versus commission. Humans regret negative outcomes from active choices, which is commission, far more than negative outcomes from inaction, which is omission. Sitting in cash feels like safety, like a warm, fuzzy blanket. But the reality is that holding cash in an inflationary environment is an active position. It's a short position on purchasing power. And the market doesn't owe Manoj his 10% dip. The 4% correction shakes out some weak hands, institutional capital steps in, and the market violently reverses, surging to new all-time highs. Manoj completely misses the entry point. Ouch. Yeah, he is left on the sidelines of this cash pile, while Rohan's portfolio just keeps expanding. We actually have incredible empirical data that models this exact scenario, don't we? Yes, we do. The historical backtests on this are conclusive. If we look at the data set running from 2019 to 2023 in the Indian market, a period that includes extreme volatility, the pandemic crash, and subsequent bull runs, the study compared a standard automated 15,000 rupees monthly SIP against a strategy where an investor holds cash in a liquid fund and only deploys it as a lump sum when the market dips by 10%. And to really understand these results, we need to clarify the metric being used. The study uses XIRR, Extended Internal Rate of Return. For anyone who isn't a spreadsheet nerd, why do we use XIRR instead of just looking at absolute percentage growth or a standard CAGR? That's a crucial distinction. CAGR, or Compound Annual Growth Rate, assumes you take one lump sum of money, invest it on day one, and check it years later. It's a point-to-point measurement. Okay, so it ignores the monthly habit. But the SIP involves multiple cash flows occurring at different times. 15,000 in January, another 15,000 in February, and so on. Each of those 15,000 rupee installments spends a different amount of time in the market and experiences different market conditions. XIRR is a mathematical function that calculates the annualized return for a series of uneven cash flows. It gives you the true time-weighted performance of your entire habit of investing. Perfect. So looking at the true XIRR for that 2019 to 2023 period, the boring, completely passive monthly SIP generated an XIRR of 16.9%. Meanwhile, the smart investor who actively held cash watched the market like a hawk and waited for a 10% dip to deploy their capital. Their XIRR was 12.0%, a catastrophic underperformance of 4.9%. Let me hammer this home. By trying to be a genius, by perfectly timing your entries to get a discount, you didn't just fail to beat the market, you actively destroyed 4.9% of your potential annualized returns. That, my friends, is the definition of a wealth tax imposed by your own ego. And that 4.9% drag is almost entirely attributable to cash drag. When your money is sitting in a savings account waiting for a crash, it isn't earning the 2% or 3% dividend yield of the index. It's just sitting there, being completely useless. It isn't participating in the days where the market inexplicably jumps 2% on positive macroeconomic data. You're literally just sitting out the best days. As the legendary investor Peter Lynch said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Preach, Peter, preach. It's mind-blowing. Okay, so Manoj is frustrated because he missed the rally. His cash pile is growing, but it's doing absolutely nothing. And this brings us to the ultimate stress test. We're moving into year 2 of our 5-year scenario. Get your popcorn, the plot twist arrives. A massive, completely unforeseen geopolitical crisis erupts. I'm talking total chaos. It dominates every single news cycle. There are red banners flashing on every business channel. And the Indian stock market takes a brutal, terrifying 25% crash over a few weeks. This is the exact moment where the academic theory of investing collides violently with the biological reality of human emotion. It's getting real. Let's check in on our automated investor Rohan. The market is down 25%. There's widespread panic everywhere. But Rohan? The 7th of the month rolls around. He doesn't even have the app installed to see the red numbers. He is blissfully unaware, probably sipping a latte somewhere. The API connects to his bank, pulls the 15,000 rupees and blindly buys the Nifty 50. But because the market has crashed, the underlying mechanics of his SIP are doing something extraordinary behind the scenes. It's like financial sorcery. This is where we need to deeply explore the mathematics of rupee cost averaging, or RCA. It is perhaps the most elegant structural advantage of a systematic investment plan, and it relies on a specific mathematical property known as the harmonic mean. Sounds fancy, right? Okay, break out the calculators. Let's use a hypothetical to make the math visible. Let's say the NAV, the net asset value, or the price of a single unit of the index fund starts at 100 rupees. Rohan's 15,000 rupees buys him exactly 150 units. Now, the 25% crash happens. The NAV drops to 75 rupees. Panic in the streets. But when Rohan's next 15,000 rupee SIP triggers, his fixed amount of capital automatically buys him 200 units. He got 50 extra units for the exact same amount of money. Here is why the harmonic mean is so powerful. Because you are investing a fixed amount of money, you inherently buy more units when the price is low and fewer units when the price is high. Over time, this results in your average purchase price being lower than the simple mathematical average of the market prices over that same period. The SIP essentially acts as a self-regulating valuation mechanism. It naturally concentrates your capital accumulation at the exact moments when assets are cheapest. It's literally a built-in clear and fail mechanism. It forces you to do the one thing every great investor says you should do: buy when there is blood in the streets. But it removes the immense psychological friction of having to actually click the buy button yourself. It forces contrarian behavior through mechanical compliance. So, Rohan's portfolio is gorging on cheap units like it's an all-you-can-eat buffet. Now, let's look at Manoj. This is it. This is the moment he has been waiting 2 whole years for. He is sitting on nearly 4 lakh rupees in cash. The market is down 25%, way past his 10% target. He should be ecstatic. He should be backing up the truck and aggressively deploying his capital. But what happens? He completely paralyzes. He does not deploy the capital. Why? I mean, this fundamentally breaks his entire logic. This is exactly what he built his whole war chest for. Because Manoj made a classic error. He modeled his financial strategy beautifully, but he completely failed to model his emotional state. Think about it. When Manoj planned to buy a 25% dip, he was sitting in his bedroom on a calm, sunny Tuesday afternoon. He was in a cold, rational state. It was just a number on a spreadsheet to him then. But when a 25% crash actually manifests in the real world, it does not happen in a vacuum. It is accompanied by terrifying narratives. The media is screaming about economic collapse. His friends are facing job insecurity. When he looks at that drop, his amygdala, the fear center of the brain, takes the steering wheel. He experiences profound loss aversion. The sheer pain of potentially losing his accumulated 4 lakh cash pile overrides his logical rule. His System 1 brain starts generating catastrophic scenarios. What if it drops 40%? What if the whole banking system goes under? I always find this psychological disconnect fascinating. Think about sneakers. If a highly sought-after pair of sneakers suddenly goes on a 25% clearance sale, people will literally camp outside the mall overnight to buy them. They recognize the value. But when the stock market, which is essentially a slice of the most productive companies in the country, goes on a 25% clearance sale, people run out of the store screaming. Why is the reaction to a discount so entirely different? It comes down to evolutionary biology. Sneakers have immediate, tangible utility. You can hold them, you can wear them, they provide instant status. Financial assets, however, are abstract representations of future value. They have zero immediate physical utility. Our brains can't process them the same way. When the price of a financial asset drops violently, our survival instincts interpret it as an existential threat to our future security. Kahneman and Tversky proved that the psychological distress of losing 10,000 rupees is roughly twice as intense as the joy of gaining 10,000 rupees. We are hardwired to flee from falling asset prices, which proves why Rohan's automation is not just convenient, it is an absolute necessity. Rohan isn't inherently braver than Manoj. He just used technology to entirely bypass his amygdala. The API pulling the money doesn't watch the news. It doesn't feel fear. It just executes the code. Manoj's intellect is actually his greatest liability in this moment. His logical brain is hijacked to rationalize why he shouldn't buy. So Manoj holds on to his cash, terrified to catch a falling knife. And Rohan? Rohan blindly accumulates massively discounted units. Then comes the aftermath. As always happens, whether it's the 2008 crisis or the 2020 pandemic, the market bottoms out and rebounds. A couple of banks step in, the crisis de-escalates, and the Nifty 50 violently surges back up by 30% over a few short months. And Manoj? Manoj finally feels the psychological tension release. The news turns positive. He feels safe. So, feeling completely secure, he finally takes his massive cash pile and deploys it as a lump sum into the market. But the joke is entirely on him. By waiting until he felt safe, he missed the entire explosive upside of the rebound. Let's look at the grand reveal at the end of 5 years. Both contributed 9 lakh rupees total. Rohan's boring, invisible portfolio, worth a stunning 15 lakh rupees. Manoj's highly active, chart-analyzing, stress-inducing portfolio, worth only 11 lakh rupees. A 4 lakh rupee wealth gap, created entirely by his own ego. Let's look at a famous 20-year backtest in the Indian market. DSP Mutual Fund modeled investors using a classic Bollywood framework: Amar, Akbar, Anthony and Saloni. Amar is our 20-year version of Rohan, delightfully boring. A blind 10,000 rupee SIP every month for 2 decades, never checks the news. Meanwhile, Saloni is the ultimate ice-cold market sniper. She holds her cash and refuses to buy anything until the market experiences a devastating 15% crash. She sat in cash through massive bull runs, navigated the psychological terror of the 2008 and 2020 crashes, tracking the market daily for 20 years. The results? Amar, our delightfully boring SIP guy, got an annualized return of 12.13%, and Saloni, after 2 decades of flawless high-stress market timing, she got 12.35%, a premium of 0.22%. That is a joke. Why on earth would anyone subject themselves to 2 decades of psychological torture for a fraction of a percent? It completely shatters the illusion of control. The relentless compounding of Amar's fully deployed capital erased Saloni's clever entry points. Time in the market always, mathematically, beats timing the market. But knowing this logically and doing it when the market flashes red are 2 different things, right? Especially when we carry hyper-gamified casinos in our pockets. Which is why the Indian fintech ecosystem is finally evolving. They are building behavioral guardrails. Take Zerodha's Kill Switch. It sounds like a spy movie, but it's basically a digital seatbelt to intercept an amygdala hijack. If you take a loss and your System 1 brain screams revenge trade, you hit the switch. And boom, it locks your trading endpoints for a mandatory 12 hours. It's a hard lock. You can't hack it. It physically forces a cooling off period. It's like a bartender taking your keys before you text your ex. And it gets better. AI is rapidly transforming into a digital co-pilot for the retail investor. They are using natural language processing. You don't need to know what an expense ratio is. You just tap the mic and say in Hindi, Tamil, whatever, "Mujhe har mahine 5,000 save karna hai." And the AI sets up your SIP. Friction is zero. AI also acts as a behavioral monitor. If it notices you logging in 18 times during a market crash and hovering over the sell button, the app intervenes. It pops up a nudge, reminding you of your long-term goals or showing how the market always recovers. It is the ultimate irony of modern finance. We are using the most computationally expensive digital architecture in human history, just to enforce the most basic, delightfully boring strategy of consistent, long-term saving. So here is the unifying truth for every Gen Z and millennial investor out there. Consistency beats cleverness every single time. You don't need a 6-monitor setup. You don't need to track MACD crossovers. You don't need to hoard cash and stress over the news. Set up that 5,000 or 15,000 SIP, delete the app, and let the relentless math of compounding do the heavy lifting while you go live your life. And a final thought. Wall Street algorithms process satellite imagery and social sentiment in microseconds to execute trades. Trying to day trade against that from your phone is like trying to win a marathon against someone who can teleport. You will lose. But what if the ultimate human edge against a supercomputer is simply the radical, rebellious act of doing absolutely nothing? Because an algorithm feeds on your emotional overreactions. Master the art of doing nothing and you starve the algorithm. You've already won a game they cannot play. So next time that influencer flexes their P&L, just smile. Know your SIP is working and keep scrolling. I'm Zoya. Thanks for hanging out. See ya! If this helped you feel better about your boring SIP, hit that like button and comment too. I'll be reading all of it. And if you want to master the psychology of your money instead of letting it master you, hit follow and subscribe. Let's keep your wealth and your sanity intact.